Good morning, everyone. Thank you for joining us today for this XRB webinar providing an update for public benefit entities. We have over 100 participants at the moment, and that number is only climbing, which is fantastic and highlights the significant interest in everything that's happening in this space. Before getting started, I just wanted to pause and note our thoughts with those that are currently continue to experience hardship across many areas, regions of New Zealand due to the flooding and the cyclones. So our thoughts are very much with you. I note the news this morning that rain continues to fall in Gisborne. So our thoughts are with those people and many others. I also wanted to applaud the efforts of our first responders, civil defence, and the many charities. So of course today we're talking about public benefit entities, which include charities. These charities that are doing amazing work across New Zealand, and especially during this time, to support those most in need. So our thanks and thoughts are with them. Recent developments have reminded us of the critical role that public benefit entities play in supporting the well-being of New Zealanders, being individuals most in need, and our communities. So my name is Anthony Heffernan, Director of Accounting Standards at the External Reporting Board, joined by Jamie Cattell, Project Manager. It's our pleasure today to be providing this update on everything related to accounting standards for public benefit entities. Maybe just it's always useful to pause and remind ourselves, what do we actually mean by public benefit entities? And we do start to use acronyms of PBEs. And public benefit entities includes the public sector. So that includes the whole of government, financial statements, local councils, and other public sector entities. Also includes our not-for-profit entities. So welcome to all the not-for-profits online today. So that includes the 28,000 registered charities. They've all got a requirement to follow standards issued by the XRB, PBE, Public Benefit Entity Accounting Standards, and soon to be over the next couple of years, incorporated societies that are not currently following our standards. Legislation came into force last year with mandatory requirements for them to follow XRB accounting standards. But they've got a few years, 3 to 4 years, to work through the implementation if you're currently not following our standards. Within the suite of PBE standards, we do have 4 tiers. So that does mean there's a lot for us to cover today. We will keep the presentation fairly high level. This is about promoting awareness of what's coming through to answer your questions around what's changing and when you need to start worrying about it in terms of it impacting the preparation of your annual financial statements. So our main goal is to give you an understanding and an awareness. We're also very keen to pique your interest in standard setting projects that are currently in development. While they're in development, you all play a critical role in providing feedback, telling us if we've got proposals right, and seeking to get the best possible accounting standards for New Zealand. We need your feedback to achieve that. So we'll highlight some of the current developments in progress and where you can provide feedback and influence. Just highlighting that Jamie will be talking about Tier 3 and Tier 4, significant improvements coming through there and simplifications to the Tier 4 and Tier 3 reporting requirements. But just to highlight, we've got a lot, 45 minutes, and I want to take time, we want to allow time for questions, that there will be future events coming through very shortly to focus specifically on Tier 3 and Tier 4 changes. But we'll at least give you awareness today of what those are in the direction that we're heading in Tier 3 and Tier 4. But if that's an area where you're focused on, look out for future presentations. With that backdrop, let's get started. A few of the housekeeping is that this webinar is getting recorded. The slides will be made available immediately. Well, I say immediately, maybe give us a little bit of time today, but you'll get an email, all participants, notifying that the recording and the slides are available on our website. All right, just getting the slides working. Cool. So moving into it, just starting at high level briefly, and then we'll get into the detail. Thinking about what are the accounting standards ultimately seeking to achieve? Why do we have accounting standards? Why do we keep having changes to accounting standards? Why can't they just be done and no longer any more changes? So it is all about maintaining trust and confidence across the PBE sector, both for the public sector and for charities. The one thing is that is consistent across both those groups is that they're funded by public money or through donations. So that trust and confidence and that charities and public sector entities are doing the right things and are operating effectively and allocating resources to where they're needed most continues to be important. And user needs and maintaining that trust and confidence continues to change and continues to evolve. So do the accounting standards. Of course, with that, you see the words high quality. We do focus on high quality, but we balance that around the cost of implementing the standards. So in everything we're thinking about, we are thinking about the preparer who has to apply the accounting standards, and that incurs costs, and also the users, the readers of the financial statements. So we're always trying to strike an appropriate balance between the cost of applying accounting standards and the benefits that provides in regards to providing useful information. So it's a challenge, and that's always why we need your feedback. Are we getting that balance right? So you know where we're heading and what's coming ahead of you in the next 40 minutes, and we are focused on getting to finishing at 1:45 to allow time for your questions. That's one thing I did miss, sorry, in the introduction, is to please feel free to use the Q&A function. Drop in your questions there. We'll try and see if we can address some of them immediately between sessions, and others that are of interest for everyone, we'll pick them up at the end. But please feel free to use the Q&A function, especially as we go through things briefly, or if anything doesn't make sense. Your questions are really important and really useful. So feel free, Q&A function at the bottom, to use that. What's coming ahead of us? We're going to talk about, first of all, I'll talk about existing requirements, a reminder that we've got some new going concern disclosure requirements. And we've also got everyone should or will be aware of the new standard PBE FRS 48 service performance. I'll provide a very brief reminder of that and highlight some of the challenges that we're seeing that entities are experiencing and applying that standard for the first time. Then we'll move across to Jamie, and Jamie will talk about the topic that is just about, I can say with a lot of confidence, is of interest to everyone: leases. What's happening there? We hear there could be changes. When are those changes going to come through? What are they looking like? When do we need to worry about it? So Jamie will give you an update on everything around leases for public benefit entities. Then I'll provide an update on a new standard which is imminent, probably going to be issued in March or April, around increased disclosures around the fees you pay to your audit firms, in addition to your standard audit fee. If you work with your audit firm, they provide other services. What are the disclosure requirements around that? Then back to Jamie, Tier 3 and Tier 4 improvements. We'll give a highlight, an update on that. And then we'll finish off with the time left, and conscious of allowing time for questions, just a bit of a teaser of current international developments from the IPSASB International Public Sector Accounting Standards Board. The PBE standards, as used by the public sector, as used by not-for-profit entities in New Zealand, for Tier 1 and Tier 2, are based on international standards. We will pick up those final international standards. We will consider, and the New Zealand Accounting Standards Board will ask the hard questions around that. And if we don't feel they are appropriate, we won't adopt them. If we feel that extra guidance is needed, we'll develop additional New Zealand guidance. If we need to make amendments to those international standards to make them work for New Zealand, we will do so. So when I talk about that, the update at the end, there are a number of international IPSASB standards which are close to completed, finalised, not exposure drafts, final standards. We will pick them up in New Zealand and then issue New Zealand exposure drafts to go back to you and ask, have we made amendments to make sure those international standards will work for New Zealand? And that's where we get into the cost benefit discussions. And then questions. So very focused on the time getting to the questions. Okay, so first topic, a couple of topics from me, and this is around existing requirements. So not new, these are things that have been around for a couple of years. So going concern disclosures. The key thing to remember is that every year when you go about preparing your annual financial statements, your governing body and management should be reconsidering the going concern position of your reporting entity. What do we mean by going concern? It means your ability as an organisation to you can continue in existence and to continue operating for the next 12 months. Of course, that's looking into the future, so that requires judgment. But based on the information you know at the reporting date and as you prepare your financial statements, will the entity continue to exist? Do you expect the entity to continue to exist in the next 12 months? As a result of COVID-19, it's starting to feel like a bit of a distant memory now, which is nice. But we remember that there was significant uncertainty, especially at the start. We didn't know what was going to happen as a result of COVID-19 and close downs. So the XRB introduced additional disclosure requirements around the entity explaining how much faith have you got in the entity continuing to exist for the next 12 months. And if there's significant uncertainty around that, if that assessment is requiring quite a lot of judgment and a bit of nervousness, then we're encouraging introduce requirements for additional disclosures around that. So with that, they were introduced in 2020 in response to COVID-19. Those requirements weren't just for then, they're enduring, they're still carrying on and are applicable now. So really interested in people if they've heard about these new requirements, which were New Zealand specific. They weren't international proposals, they were stuff we brought in specifically for New Zealand. So Jamie's opened the poll.
It's running now.
Cool. So that's, yep.
Still got about 40 people to go. I think that gives us a pretty good idea. So I will be stopping the poll. Here we go.
Cool. Thanks, Jamie. That's fantastic. So we've got the majority of people in the middle. They're kind of fairly familiar with them. I'm reading this that you've heard about them, you know they exist, but there's a lot of people that don't know much about them. So a reminder is useful. Okay, so just what are the requirements, and just seeking here to summarize them pretty quickly. But the key thing you need to ask yourself when you're considering that going concern position, which is required every year and is a key focus for your auditors, that will be always the case. If there's significant judgment in making that assessment, whether you'll keep operating, whether you'll plan to continue existing for the next 12 months, and there's material uncertainties around that it's requiring estimates about the future, which you're just not sure what the outcomes would be, then that is requiring additional disclosure. Of course, during COVID, and I think this will continue, we hear a lot about entities pivoting. So it doesn't mean that you need to disclose if your activities are going to change. If you're going to pivot and do new things, that's fine. That does sound like useful information you might want to disclose, but that's not related to your going concern position. It's all about whether can you continue operating, can you continue getting the funding you need to keep going. So the key change is that if there is uncertainty, there's now a specific requirement to disclose management's plans. How does management plan to mitigate those uncertainties? That might be that you plan to pivot, or you plan to get additional funding, or you plan to reduce overhead costs or sell a building. What do you plan to do to mitigate those material uncertainties? Now there's a specific disclosure requirement around that, and the auditors will be looking for that in these circumstances. Okay, just highlighting here, I'm not going to talk about this slide. There's a lot here. The slides will be shared afterwards. But just highlighting, we have issued guidance around this that highlights the disclosure, sometimes the disclosure expectations, what you should be considering to disclose, and the disclosure requirements, what you should be disclosing in certain circumstances. And it all depends on how much judgment is required when you consider that going concern position. Encourage people to look for that guidance. In the next couple of weeks, we are issuing refreshed guidance on going concern, so look out for that, specifically developed for PBEs. Okay, moving on. So next section is service performance reporting. We've talked about this before. We've talked about this over the last 3-4 years. We've done specific webinars focused purely on service performance reporting. So I'm hoping the majority of you are aware of this new standard. Remembering that for public sector, it's only required if a public sector entity is required by legislation to report service performance information in accordance with GAAP. It's public sector government entities. For all charities, registered charities, and other not-for-profit entities with GAAP reporting requirements, you are required to follow this standard. Tier 1 and Tier 2, and there's simple requirements for Tier 3 and Tier 4. This standard is effective from accounting periods commencing 1 January 2022. So in theory, first year ends impacted, so accounting periods commencing. First year ends impacted 31 December 2023. Effective 1 January.
31 December 2022.
Yeah. It's pausing that, it's like I'm getting this wrong. 31 December 2022. So there's year ends that are applying this and got a mandatory requirement to apply it now. So then your follow on, if you've got a March balance date, your first balance date with 31 March 2023 and June 23. So what it's about is explaining what your objectives are and explaining your activities. What have you done in the year to advance those service performance objectives, to advance your public sector or charitable objectives? So without going into the detail again, the main thing we're seeing, the challenge is that the standard is requiring you as a reporting entity, as a governing body, as an organisation, to consider when you're reporting on your performance, being how you're advancing your objectives, to report appropriate and meaningful information. It's interesting, I was thinking about this last night, and as I've been doing presentations with, and I feel like it's slipped in that we've talked about providing the most appropriate and meaningful. Everything in the standard, you've got to be careful of the wording. It doesn't say the most appropriate and meaningful. It says report information that is appropriate and meaningful to users to understand why you exist and what you've done in the year. That requires significant judgment. Just 2 examples to maybe help is that I am involved in a charity that is looking to help people experiencing hardship. Their main activity is to provide food parcels. So I'm reporting our service performance information that the charity that I work with, reporting the number of food parcels delivered to families. That's appropriate and meaningful information. That's really useful. The reader can understand from those donation dollars what we've done. We've delivered X amount of food parcels for free for families in need. So some entities like that, it can be fairly simple to explain what you're doing and how you're advancing your objectives. But then for other entities, it could be much harder. And I think about the XRB, and we've had these challenges. And the XRB, from an accounting standards perspective, we've got 2 key activities, at least there's more, but 2 I think about issuing accounting standards and another one is influencing international boards through submissions. We can easily report the number of accounting standards. I can also easily report the number of submissions we've made to international boards. But is that the most appropriate and meaningful information for users to understand how we've advanced the XRB's objectives? No, I would challenge us. We're challenging ourselves on that, and we're challenging ourselves on coming up with service performance measures that measure the quality of our accounting standards, how we're actually assessing if they're high quality. And we're also challenging ourselves to come up with service performance measures that measure the impact of our submissions to international boards. We can all write letters to the ISB or the IPSASB, but how do we go about assessing the impact of that? We feel our users would be really interested in that type of information to be able to get a better understanding of the XRB and how we're advancing our objectives. So this requires real challenging questions at the board, at the management table, around how you're reporting your service performance. Some entities easy, some it requires a lot more discussion. So it's not always easy. But it's all about charities, and public sector entities should be able to explain their purpose, and they should be able to explain what they're doing. So that's the core objective of this. This slide here is just highlighting that we've got guidance material that's available on our website. We've got summary guidance material, detailed guidance material. The detailed guidance material has lots of examples to help you get started. Lots of entities are already working through this and doing a great job and are seeing the benefits of reporting their service performance information. It really is useful information for donors and funders and other stakeholders that want to understand what is the charity and what is the public sector entity about. Cool. Moving on. And I think we may be handing across to Jamie.
Yes, thank you, Anthony. Moving on, the topic that we need to talk about next is one that, as Anthony mentioned, we're sure has a lot of interest for many of you, and that is the upcoming accounting standard on leases for PBEs. For those of you who aren't so familiar with what's going on here, last year the XRB issued an exposure draft which proposed new accounting requirements for leases, and that exposure draft was based on IPSAS 43, issued by the International Public Sector Accounting Standards Board, and that proposed new accounting requirements for leases, which were based on the requirements in IFRS 16. What that means is that the key feature of the proposals was to introduce the right of use model established in IFRS 16 for lessees, and that will result in most leases being recognized on the balance sheet in the form of a right of use asset and obviously a lease liability. From a New Zealand perspective, adopting this standard into the New Zealand suite for PBEs, so for both public sector and not-for-profit entities, will provide benefits of ensuring that we're aligned internationally and comparable with other jurisdictions that apply that right of use model to their leases. It will increase transparency around the lease arrangements that PBEs enter into. In other words, it provides a more complete picture of the resources available to entities to fulfill their objectives. And it also addressed some concerns that were arising to do with mixed groups, being groups that have both for-profit and public benefit entities in them. Before this, without the standard being in place, we're still under the old IPSAS 13, which retains your classic model of operating and finance leases. But of course, for-profit entities in New Zealand have equivalent to IFRS 16, which is applying the right of use model. And that could make it somewhat complex for these groups with entities of both kinds. And if you had to consolidate that, it could result in adjustments, or would result in adjustments, depending on who was the ultimate parent. There is a lingering question mark in this standard, considering that it's been widely discussed in the context of it that there is a public sector specific concern around concessionary leases, and the IPSASB knows that this is a complex area. And so as part of progressing this work, when they were issuing their original IPSAS 43, they split their leases project into 2 phases. So phase 1 dealt with the accounting for ordinary leases at market rates, which is primarily what's represented by IPSAS 43. Phase 2 of the project, which is still ongoing, was to address the accounting for concessionary leases, which are leases entered into at below market rates, and other issues that are more relevant in the public sector context, such as access rights arrangements, share properties, that sort of thing. These things that look kind of lease-like but aren't strictly leases necessarily. Of course, this left a little bit of an ambiguity. So the exposure draft that we issued last year included a New Zealand specific clarification that concessionary leases are not accounted for at fair value, and that they should just apply the standard model as it's been set out there. And we intended to revisit this matter once the IPSASB issues a final standard on accounting for concessionary leases. It's likely, if you've been following this project, that you'll have other questions on concessionary leases, and we'll come back to that topic in a moment. But first, we wanted to briefly go over the feedback that we received on the exposure draft. The headline here really is that overall, the feedback we received on the exposure draft was mixed. There was general support for incorporating IPSAS 43 into our PBE standards, but some constituents did raise concerns or raise matters for us to consider. Respondents in the public sector space were focused on some of the more specific elements of the standard, and they recommended several refinements and additional guidance around issues such as sale and leaseback or leases of low value items. Some did raise the matter of concessionary leases and suggested that we should think about these leases and other arrangements which are lease-like more deeply from a public sector perspective, rather than necessarily just assuming that they're the same as standard leases at market rates. Our respondents from the not-for-profit sector, on the other hand, weren't as concerned with the specifics of the proposals and were more interested in the costs and the benefits involved in applying the right of use model. These respondents had some concerns that the costs of applying the right of use model to their leases would be significant and, in their view, would outweigh the benefits of applying the model. And this was a particular concern, knowing that this standard, if it came in, would be applied by all tier 1 and 2 not-for-profit entities, which range from 2 million annual expenditure up to over 30 million. And so the degree of technical capability or the resources available to them to apply this, and we have heard that there can be significant work involved in transitioning to the right of use model, that they wouldn't necessarily have the resources or the skills to be able to do that. And we really wanted to highlight that we do take these concerns seriously, and we are considering what options are available to address these concerns for the not-for-profit sector. We have yet to make any final decisions on how to do that, but we are continuing to work through that. So that leaves the ultimate question, though, of what are the next steps for the leases standard? Feedback on ED PBE IPSAS 43 was discussed by the New Zealand Accounting Standards Board at its February meeting, and they decided to proceed with developing PB IPSAS 43. And in this case, it would be without waiting for any further developments for concessionary leases and retaining that scope clarification. But we would only be doing so after considering the concerns raised by not-for-profit entities in more detail and having some more conversations with those entities. All of that is to say, we are still working through the final stages. The important thing as well to keep in mind is that we are not anticipating that this standard will become mandatory until quite far down the road. Our expectation is that it will be 2027 at the earliest that these requirements will come in as mandatory requirements for PBEs. So the next part, though, obviously I mentioned earlier and said I'd be coming back to it, was that second part of the IPSAS-B's leases project, which was to do with concessionary leases. Recent developments in here are that in January 2023, so this January, the IPSAS-B issued Exposure Draft 84, concessionary leases and right of use assets in kind, as part of phase 2 of the project. You might be wondering what is meant by the term right of use assets in kind. If you've been following this project, you'll remember that the IPSAS-B were referring to something, leases for no consideration, which they've now decided to refer to those as right of use assets in kind because they don't meet the definition of a lease, which is a contract that conveys the right to use an asset in exchange for consideration. And in this case, there's no consideration. So essentially, right of use assets in kinds are arrangements that convey the right to use an asset at no cost to the recipient of those rights. But before I talk about what's actually being proposed here, I wanted to ask Anthony a scene-setting question, who's been at the IPSAS-B's meetings while they were developing this exposure draft. And I was wondering if you could explain to our attendees today what the IPSAS-B were considering the main benefits of the proposals were. What were they trying to achieve with this standard?
Thanks, Jamie. It's a really good question. And I think we can pick up pretty quickly that these proposals look complicated. This idea of measuring the concession element of a lease being, what would you pay if you're paying a market amount for something that you've been given for free, or maybe a lease you've been given for $1 or $10. If you're paying market amounts based on its current use, what would that be? So why is the IPSAS-B seeking to bring this in? It is around increasing transparency and accountability around these arrangements. For public sector, if they're effectively giving away concessionary leases, there's a cost there. Public sector should be held accountable for these arrangements, and when they're giving someone the right to use an asset for a discounted amount, there should be a public sector or public policy decision around that. So they're trying to give transparency around that. On the leasee side, the party receiving, so maybe you're a scout group and you're receiving a hall for free from the local council to use. The idea from the IPSAS-B at a conceptual level is if that scout group is measuring the full amount of that lease at market amounts, then that's going to promote increased efficiency of use and increased focus on the service delivery, the use of that asset. So the idea, if it's on your balance sheet for $1, you're not going to look after it as well as if it's on your balance sheet for what it's actually worth, which might be $500,000. So it's that kind of idea. When we're thinking this through, yes, one option is bringing it onto the balance sheet and following the IPSAS-B proposals, but could these outcomes of increasing accountability, increasing efficient use of assets be achieved through other ways of providing information through other means? So we're currently thinking that through. But remembering this is an IPSAS-B ED at the consultation stage.
Thank you, Anthony. That's very good. And you've touched on some of the stuff that I needed to raise anyway, but I'll go over it. Anthony alluded to it. And the main proposal here in this ED is for lessees to recognise right of use assets on the balance sheet for both concession releases and these right of use assets in kind. But rather than measuring them based on the contract payments of the lease, which in the case of right of use assets in kind would be impossible when there are no payments, it proposes that they should be measured on what the lease payments would be at market rates based on how that asset is being used, unless that information is not readily available. If you've been following the leases project for years since the beginning, you may recall that we've consulted on similar proposals in the past. Through this prior consultation, and this came out from the IPSSB back in 2018, something like that. We heard from our stakeholders that there were significant concerns about the proposals, which at that time were to measure concession releases at fair value. And based on that feedback, we conveyed these concerns to the IPSSB and highlighted that we considered the benefits of recognizing the value of the concession in this case would exceed the costs of determining the estimated market value of that lease. Because these proposals are similar to those previous proposals, we're not actively consulting on ED 84 at this time, but we want to highlight that we will be making a submission to the IPSSB on the CD, which will reiterate the feedback that we received in those prior consultations. Going forward, as Anthony alluded to as well, we'll also be considering whether a New Zealand specific project on concession releases is required, and this will be discussed by the the NZASB going forward. However, while we aren't actively consulting on ED 84 at this time, you are still welcome to send us any feedback you have if you feel strongly about the proposals, and we'll have details at the end of this presentation about how you can do that. But while we have you, we were hoping to get a little bit of information from you. And we wanted to check or ask you whether concession releases were something that are relevant to your organization. So we'll launch that poll now. And we were hoping to find out whether you're on the lessor side, on the lessee side. Are you both? Do you give out and receive concession releases, or do you not deal with them at all? And we'll just allow that to run for a little bit. And it looks like it's trending towards most people not dealing with them. All right, just let that run for another 10, 15 seconds. Okay, there we go. All right, so it looks like most people who answered don't deal with concession releases at all, but there were a number of you that do deal with them. So these proposals will likely be relevant to you, and we recommend that you keep an eye out, because we'll be actively discussing this as we get closer to a final decision about how we're going to approach the topic. And with that, I will hand back to Anthony to go over disclosure of fees paid to audit firms.
Thanks, Jamie. That's really useful to get an understanding of everything that's going on in the lease accounting space. I just want to highlight really briefly a project which we issued an exposure for draft for last year, and we're getting very close to issuing a final standard. So we are expecting to issue a final standard around disclosure of fees paid to audit firms, and probably around April time. And that will have an effective date of, currently proposed, but very close to being finalised, effective date of counting periods commencing 1 January 2024. So from then onwards, there'll be additional disclosures required when you're paying fees to your audit firm for other services. So that might be that you're engaged with an auditor, but you also work with their business services team at the same firm, and maybe they provide some advice on your GST return, or they help out with some restructuring, or provide some other kind of advice that's done by their business services team or another team at that firm, in addition to receiving audit services from the audit team. So I think everyone can understand that that's an area of high interest to people due to perceived risks of independence when you're engaging with an audit firm to provide other services in addition to your financial statement audit. So in those cases, we have issued, we are proposing and about to finalise additional categories that you need to disclose when you receive other services from an audit firm. So these are the finalised categories as they stand, and we'll be issuing that over the next couple of months. But in the spirit of time, just want to give you an awareness of that, look out for it, and we'll do a separate webinar on that shortly after it's issued. Thanks, Jamie.
Okay. So didn't vanish for too long. Coming back now to talk briefly about the Tier 3 and Tier 4 improvements. So for context, everything we've talked about up until now is applicable to Tier 1 and 2 PBEs. So now we're talking about the proposals for the smaller PBEs out there. So entities that spend less than $2 million per year. And in the case of Tier 4, that spend less than $140,000 per year. Bit of background that I will go over briefly. In 2022, May through September, we consulted on proposed improvements to the Tier 3 and Tier 4 standards. We've talked about this in a lot of detail before in other webinars, which are still available on our website. So I'm just going to give you a high-level overview of what we proposed. When we exposed these for Tier 3, we were proposing amendments that will make it easier to defer revenue through the introduction of a new documented expectation principle rather than the user return conditions that were previously being applied. We made some refinements to the service performance reporting requirements to align the terminology more closely with Tier 1 and 2, but not to align the requirements themselves in terms of their complexity with Tier 1 and 2. We proposed to introduce some new simplified revaluation requirements that would be self-contained within the Tier 3 standard, as opposed to being required to opt up to PBE standards if you wanted to revalue your assets, but only for simple revaluations. So things that like publicly traded financial instruments have an actively quoted active market with a quoted value, that kind of thing that doesn't require judgment. We refreshed or proposed refinements to the revenue and expense categories, changes to the labels, how they were being described, was one of the big areas that we needed to focus on. And we also increased the number of categories, which would allow those categories themselves to be more specific and allow us to provide more guidance about what goes where. And we were also proposing for Tier 3 some enhanced disclosures around accumulated funds that would involve entities providing information about the purposes for which they're accumulating funds. Tier 4, on the other hand, was a bit of a different beast. At that point, we've done a full rewrite of the Tier 4 standard and made it much shorter than the original version. It's about half of its original length. We did the same kind of alignment of the terminology for service performance reporting with Tier 1 and 2. We removed a number of requirements. We refreshed the receipts and payments categories, so like the revenue and expense categories in Tier 3. And we were proposing additional concessions for what we were describing as small Tier 4 entities. And that was one of the more significant proposals. But what did we hear back? So on this slide, I've focused on the main areas that people provided feedback that wasn't entirely in agreement. In Tier 3, for the most part, people were very supportive of the changes to revenue and of the changes to service performance reporting requirements. So I haven't included anything on them here, but the areas where there was a little bit of mixed feedback were around revaluation of assets, where we had general support for including those revaluation requirements in the Tier 3 standard, but there were some different views about how gains should be recognized and presented in the financial statements. Some people wanted them through the profit and loss. Some people wanted them through something that looks like other comprehensive income. And so we have recently discussed that with the board, and as a final decision really ended up being that we were going to retain what we originally proposed, which was for revaluation gains on property, plant and equipment and investment property to go through basically to be recognized straight in accumulated funds rather than going through the P&L. Financial investments, publicly traded ones, that was originally proposed to go through the P&L, and the change that we are making there is that we're allowing it as a choice. You can choose to put them through the statement of financial performance, or you can choose to put them straight into accumulated funds in a revaluation reserve. The categories, people were generally in agreement with the intention of what we were going for there, that we do need to have minimum categories. They're a good idea, that they did need to be more clearly defined, and they were generally supportive of the number, but there still was some concern about the length of some of the labels, and there was a need for more guidance on some of that. So we're working on introducing some more things to respond to that feedback. The enhanced accumulated fund disclosures was more mixed. There were some concerns that applying this principle of explaining why you have accumulated funds to all your accumulated funds section in general could result in some unintended consequences, or almost be a bit of draw attention to something that in some cases is not something that entities have discretion over. For example, you have accumulated funds that are tied up in property, plant and equipment. And that's what they do. Is there any real need to explain that? So we've heard that feedback, and we are planning to reinstate the requirements that we'd previously proposed removing around restricted reserves as an optional disclosure if they want to, but we are retaining the enhanced disclosures, but instead of focusing on accumulated funds generally, it will be focused on reserves. So both discretionary reserves and any restricted reserves that an entity has if they choose to use that. And that allows us to focus those on the parts of the accumulated funds that entities probably have some discretion over. Tier 4, overwhelmingly, people were also in agreement with the service performance proposals there, but they did want us not to introduce the disclosure of the medium to long-term objectives, which was previously not there. We thought that it would be something that would be useful, but in most cases, for simple entities, it's relatively clear that what their medium to long-term objectives are. And so we are removing that disclosure. Of course, you can still provide that information if you want to, so it simply won't be mandatory. The refreshed categories, we got a lot of feedback on those, and it really shows how hard it is to get a set of categories that relate, that are relevant for all entities. But again, like Tier 3, agree with the principle, agree with introducing some more categories, but we have shortened the labels and added some more guidance. There was some desire for more simplification, for some more things to come out, and for some things that were previously judgmental to be made a bit more rules-based. For example, significant assets, and that's exactly what we've done. Previously, in our proposals, we were asking entities to apply their judgment to find or determine what significant assets needed to be disclosed. Now we've amended that to require disclosure of a specific list of assets if those apply. And the small entity concessions, those were quite mixed. Feedback-wise, people thought that introducing this small entity threshold and having these paragraphs that people don't have to apply if they're under a certain size made the Tier 4 standard more complex. And on consideration, we agree. And considering the feedback that people still thought there was room to simplify further, what we've proposed here, or ended up with in the final standard, is that we've extended most of those concessions we were previously proposing for small Tier 4 entities to all Tier 4 entities. And that's the big headline. Most of those concessions are now just available for every entity that is in Tier 4. And on the slide here, we can see the concessions that we've extended to all entities. Those are on the left. We did remove a couple, and in particular, the ones that we thought were useful information and were likely to be significant for users of Tier 4 financial statements. I won't talk about what each of those are in the interest of time, but those are there, and you can see in the final standards. The other thing to briefly touch on is the date of availability, which I'm sure you're all very interested in. Currently, we expect Tier 3 and Tier 4 to both be issued in March, so within the next month, with an effective date of 1 April 2024. So that will be the mandatory date. Our intention is to make those also available for early adoption. So those entities that want to take advantage of the new Tier 4 standard as soon as possible will be able to do that. And that is it from me. So I'll hand back to Anthony to talk about some of the final stuff. You're on mute, Anthony.
Yeah. Thanks, Jamie. And we've come to the final section. We've covered an awful lot of information, again, to give you awareness of the new things coming through or in progress. For the new requirements coming through, we will be hosting individual events. We can go a little bit more in depth of what these new requirements are as they come through. Touching very briefly on the future, some of the things you may have heard about, so you at least got awareness of it coming through from the International Board. So all these types of things with it, in regard to impacting New Zealand and introducing new reporting requirements, we're now talking about 5-6 years away at a minimum. But for those that are following international projects, just a few highlights. The first one is sustainability reporting. And that's a huge topic on itself. We know that there's new standards coming through from New Zealand, there's new standards coming through internationally for companies and for-profit entities to report on their sustainability measures and the impact that climate change is having on those organisations. So the public sector, the IPSAS-Bs, accepted an invitation from the World Bank to consider public sector specific guidance on the public sector reporting on sustainability measures. Both in regards to the impact the public sector is having on the environment and also on the environment, and also the impact of climate change on the public sector itself and whether they need to change their operations in the future to adapt to climate change. So the impact on and the impact as a result of climate change. So very early days on that in the public sectors and scoping, and IPSAS-Bs in scoping and research stage of that project, but looking to develop some guidance. And there is urgency, of course, around everything around this and everyone doing their part, including the public sector, possibly including charities in the future, to be operating in a sustainable manner and to report on that. Concession leases touched on that. Revenue and transfer expenses, we've talked about this many times. The headline news is the IPSASB in March next month are expecting to vote on the approval of a final standard. Once they approve the standard, then they'll consider carefully, has it changed significantly from what they exposed 2-3 years ago? If it has, they may need to re-expose. So look out in March. Will we have a final international standard, or will we have a new exposure draft? We'll pick that international standard up in New Zealand once finalised and adapt to make sure that's appropriate for New Zealand and issue that for consultation. Headline news is, for certain circumstances, it should allow more flexibility for you to defer revenue recognition over time. Getting close to the term I'm not allowed to use, but matching, getting closer to that. But we'll do a separate presentation on that once we get close to it, years away from becoming effective and mandatory. Again, new requirements coming through on measurement, how public sector measure assets, when you revalue them. So if you carry assets at cost, less depreciation, not much change. But if you revalue them, lots of people revalue land and buildings, especially every year, changes coming through on how your valuer goes about putting a market value or a replacement cost to your land and buildings. Again, the IPSASB are looking to issue a final standard in March. Then we'll pick it up in New Zealand and look at it and say, is this going to work for New Zealand? What changes do we need to make? And then we'll issue that for public consultation in New Zealand. Big topic for the public sector government around how they measure their assets that impacts the New Zealand government's balance sheet. Charities will need to consider carefully around making this easy for charities that want to revalue their land and buildings or any other types of assets. But look out for that, but years away from becoming mandatory. Cool. So I think with 3 minutes left, we'll take any questions. So now's your time. If you've been holding back, we have had Q&A questions come through that we've responded to, and I'll pick a few of them, just of ones that may be of interest to everyone. But if you've got any questions now, please chuck them through, and we'll have a look at that. Just first checking, there's 2 that have come through that are unanswered. So I haven't thought about these yet. I will read them out while I'm reading. Jamie, have a think. Yeah. Did I hear right that in the Tier 3 investment revaluations would go to a revaluation reserve? Why? Shouldn't you try for the same in Tier 1, Tier 2?
Yes, you did hear that correctly, but it wouldn't be mandatory. The reason that the board decided to allow an option to put it through a revaluation reserve was for consistency for these less complex entities. So the revaluations of property, plant and equipment and investment property, which would be treated the same way, are going to be going directly to a revaluation reserve in accumulated funds. And if an entity was already doing that, having them do a different kind of treatment for financial investments could be too complicated for them. That was the feedback that we'd gotten. Of course, we did think it was still important to allow for that consistency with Tier 1 and 2 and putting it through the statement of financial performance, which is why it's now an option rather than a requirement.
Cool. Thanks, Jamie. We've just got another question that's come through that's still open, and I've received a similar question on this. And this is around the impact of the new leasing standard and maybe impacting your expenditure and moving you into different tiers. One response to answer this question is about fluctuations, and what do you do if you're borderline between Tier 2 and Tier 3, floating around that $2 million expenditure mark. And it may be useful to remember that the moving between tiers, you only move if you're over the size threshold for 2 consecutive years. That will help.
Yep, and it's in that 3rd year that you have to move up. And if at any point your expenditure drops below the threshold, you basically reset your count. So if you are over for 2 years and then the 3rd year you're under, the way that the tiers work, it will allow you to then move back down and just continue applying tier 3. So it really only pushes you up if you are consistently over that threshold.
Yep. So I know we have come to time, but we'll answer a few of these questions and then we'll finish very shortly. There's another message question that's come through from James. This is an excellent question. And this is around the IPSASBB's proposals to recognise concessionary leases based on your kind of estimated market amount, what you would pay on market terms. So James' question, where is the evidence that placing a value on right of use in kind, so arrangements you get for free, lease arrangements, would result in more efficient use of the asset? So really good question, James, and we're challenging the IPSASB on the same question around will this information influence decision making? What impact will it have? And yeah, all I can say is we've got the same questions. So we'll be raising that with the IPSASB as we work through. Cool. One of the answered questions, and we haven't covered all the standards today, is that we did recently issue a new standard for PBEs on insurance contracts, PBE IFRS 17, mainly, just about only, there might be a few others, but mainly impacts ACC and EQC in the public sector that have got, and some not-for-profits are involved in providing insurance. So we have got a new standard that's been approved by the New Zealand Accounting Standards Board. And the question is, when is that coming in? From 1 January 2026. I hope I've got that right. And we're looking to publish that as soon as possible. Cool. So looking at time, we'll just finish off. And please, if you've got any other questions, contact us directly at any time. We love to talk about your questions. We love to talk about your issues and try our best to help, especially for smaller charities and others that may not have that same level of support that other large organisations do. Just highlighting, finish off, as we're thinking about XRB's statement of service performance information, we're looking to get better at measuring our impact and how we're doing our job. So we have got currently open a stakeholder survey on our performance. So the link's there, the link will be in the slides later. So please jump into that survey and tell us how well we're doing our job, so we can report our service performance and do better and look for areas where we need to improve. And then finally, our contact details are there. I just want to a huge thank you for all participants and your time today. And again, if you've got any questions, feel free to contact us at any time. We'd love to hear from you. So thanks very much. We'll close the session there, and you can look forward to the slides and the recorded of this webinar coming out very shortly. Thank you.
Thank you.